Welcome everyone to our Gentian weekly webinar. It is a pleasure to be here. We're grateful and glad to be here both. It's a beautiful day again. We noticed last week our listenership dropped off significantly because it was about 75 degrees in the first warm day in about, maybe 6 months. So we noticed that as well. But a lot of you have gone on and watched some of this on the web, which is good to see. That's why we record these and you can watch them later. The intention of this is really to put together some topics that are important, some timely and some timeless, if you will. Today, I think our topic is going to be one on behavior. So what happens right now with behavior? There's a lot of correlations that go along with that. So you'll get through some of these pieces, how behavior affects your portfolio and planning, and some of the mistakes that people make from that as well. You're seeing a lot of behavior right now, some of it really, really bad, by a lot of different people, government, by different neighbors you might find, by people in the Ozarks at a pool party. In the CDC, there's some people that are just absolutely irked about this. Remember, the one thing you control is your reaction. The one thing you can't control is what other people do. So again, we got to make sure we do that because a lot of frustration can happen when you see others doing stuff that you're not doing. So a big portion that we're going to talk about too is just the self-discipline and leading yourself right now. Leadership will be important. But first, as we always start, we got to do some housekeeping. In this next week, we have our second women's Zoom gathering, and it's a virtual gathering on Friday the 29th, so that will be in 2 days on my daughter's birthday. At 11 a.m., email Ashley if you have any other questions whatsoever. The team will be there, and it'll be a great group. It's one of those neat things if you haven't participated in yet. It's nice to share with some other like-minded people and get a little bit of diversity as well. So please sign up for that if you haven't already. Next Thursday, we're going to have special guest Dr. Jeff Gladden. So moving forward and past COVID-19. So Jeff, you've seen before at our client event. He's a world-renowned expert when it comes to both longevity, healthy living, and health optimization. So in this, we thought, while the U.S. is opening, as we're all going back out, what are we going to do? How can we remain healthy? So we want to bring you some resources like Jeff to give you some medical guidance or some guidance on things you can do to keep yourself healthy, even if others around you may not be doing what they should. So we thought we'd bring some of that in as well. Another piece is we got questionnaires coming in waves, and I think that's something that you're going to start to see. One of my clients says, when did you start a dating service? And I said, well, what do you mean by that? So I guess the questions are really out there just for us to get to know you better. We've gotten 5 or 6 of them in. It's really interesting to see that, and we'll start sharing our personal ones with you as well. So those will be kind of fun as well. But as you see these coming back, we just want you to take a look at those, take a moment if you can fill those out, and return those to us. If you don't want to, that's fine as well. We understand it. But it's really beneficial for us to get to know you even better.
Yeah, on June 10th, so coming up here in a couple weeks, you're going to start receiving a lot of emails if you signed up electronically for what we call the regulation best interest disclosures. Those are coming out. You might get them in the mail. You might get them electronically if you signed up for that. So really what that is it's a lot of things in the industry are changing. The industry wants advisors to look out for clients more and more. That's interesting to us because we've been doing that natively for you for a long period of time. It's going to talk about the financial planning process, which we're going to talk about in a little bit. Again, things we've been through consistently with you together for many, many years. It's just being a regulation now over the industry to make sure that customers and investors are really getting the advice and the guidance they really need over the years. So that's coming to you in a few weeks.
And the one thing Ken didn't say, it's going to be written in legalese. So just in case you're wondering if you couldn't read it or interpret it, it's written in another language. Anyhow, so we like to start with something funny. So one of the things I like it's kind of interesting here. A lot of people just lately have been noticing my beard. I've actually grown it since November. It's pretty funny, but since a lot of people have noticed lately, I used to hate facial hair. I used to just hate facial hair, and then it grew on me. So I just had another one as well, is that you guys have been hearing about the short supply of everything, toilet paper, pork, hand sanitizer and all. What's interesting is, did you hear the rumor about butter? I'm not going to spread it. So when does a joke become a dad joke? You hear these, right? When does a joke become a dad joke? When it becomes apparent. So at any rate, I'll leave on those. I always like to start something. I kind of thought maybe I'd just start with a monologue, like a normal, Tonight Show or something, and stand up that way. So we may transition this to a normal monologue, but that's some of the pieces that I start with here. On a serious note, I want you to know and understand what we're here for. We are here for you, and we understand the basis of what we do. We're here for your finances. We're here for your financial planning, to take all the information coming in and help you make great decisions and adjustments for you as well. That's the base foundation of what we do. What we also understand is there's another level to this. Once that's taken care of, this money is simply there to support something much more important to you, something we call true wealth. In the total picture, true wealth are the things that, maybe a kid's college, maybe your retirement, maybe it's vacations, maybe it's, just all sorts of different extremely important things to you. So as such, we look at this as we bring you some different topics that may be helpful to helping you live your best life. A couple things we're starting like with Dr. Gladden you're going to see as well, maybe some dietitians, psychologists on how to deal with both retirement and the COVID timeframe as well. We're bringing these to you because we know that we're able to get some relationships and connections that are really, really good. They've helped us tremendously, and we believe we want to offer those to you and help you. But don't get us wrong. You'll see a lot of stuff out there, and the stuff that's new, it's fun and exciting. But we understand the base for what we do is your fundamental financial planning and needs when it comes to markets and investments. We get that. The thing is, we understand that you're a whole person, and that's not all. We'll offer other things as well. Consume them if you will. But I just wanted to say those are coming up as well. One of the things as we kind of head into mindsets and perspective, and this week Ken, myself, and Zach, who will be returning next week, talked a lot about some of this. We talked about leadership and self-discipline. Now, let me make an idea right here. 2 weeks ago Wednesday, when you saw the pictures of people in bars in northern Wisconsin, that gave a nice reputation to our state, right? That already had a reputation of being beer-drinking bar goers. But you saw something in the Ozarks as well. You're seeing this all around the nation: crowded beaches, crowded pools, people not social distancing now. They're saying to heck with it. Remember, we talked about this, is that the Americans are extremely independent. They don't like to be told what to do. What's interesting right now is it's really testing. So when you see others going out and doing all the things that you want to do, but you know it's not safe, it takes leadership and self-discipline at this point in time not to follow the crowd. The crowd is doing all this stuff. The news is going to follow that because that's not supposed to be done now. So looking at this is a tough time. Everybody else is doing it. It's like when people get out of school, but you got 3 or 4 classes left, you want to be out. So we understand that. The weather's getting nice. A lot of things are occurring, but we want to make sure that we understand right now that leadership and self-discipline is tough. You're getting a lot of leaders really saying some conflicting things as well, so it becomes quite difficult. But I just want to urge you in this case still to really be careful with this saying to heck with it. If it's another couple weeks that keeps you safe, and we've been talking about that, let's continue to do that. But we know what that takes. That takes discipline. And if you're in a high-risk category, take time to decide and make sure that it's worth it for you. Don't let what's going on or go, oh, to heck with it. Really guide you on that as well. So that's a piece we wanted to offer you some support on as well. We're not having meetings here in the building still. We want to have a couple of weeks or maybe 3 or 4 weeks and see what happens with people getting back together in social gathering, and see what happens with a spike or not. So we've got some very good sources we can follow on that piece as well. So we just wanted to put that out for you.
Yeah, there's going to be some interesting decisions we all have to make coming up right now. You, being a grandparent or a parent of your children or grandchildren, like Little League right now is being talked about. Will they have a Little League this year? Will it start in 2 weeks from now? How is that going to look? So as a grandparent, do you go to that Little League game? Do we as parents let our kids play in these leagues right now, or is it not safe? So these are all decisions that we're going to have to make coming up here pretty soon. So
yeah, I agree, Ken. I mean, there's also decisions of my mom has said, do I go back to the YMCA and go in the pool? These are decisions coming up. So she's going to delay that 3 or 4 weeks, I think, which is awesome. Those are great decisions to make, but everybody else is going back. Well, you know what? Make a decisions based upon your safety. So that's an awesome point too. We're getting a lot of people also now asking for our kids to come over. We love them to death. We'd love for our kids to come over. But as long as they're still social distancing, as long as they're not going into somebody's house, as long as it is, we want to keep people safe for a period of time. We don't want to waste the last 8 weeks of the discipline we've had for 1 or 2 weeks of, we're just going to be crazy here, and then kind of thwart everything we've had occur. So I think it's an interesting piece, and I think when we look at this, as Ken and I were talking too, behavior is a really important part. We want to actually come back to this. There was a great study done just by Russell Investments recently we'll talk a bit more about. But these are actually 5 different behaviors that we want to watch out for. So we're going to go back and forth in some of these as well, and I'm going to start with these. But 5 different loss aversion, or 5 different behaviors, I guess I should say, you should be careful of. These are things that we are wired for as human beings. We have some basic wiring to all feel this way, but we're also wired to be able to respond versus react to something. So we're going to talk about a few of these as well. The first one as we come up, it's a behavioral bias called loss aversion. People hate losing. Matter of fact, if you were to lose 10% or gain 10%, some people have said it's about 10 to 1, how much more people hate losing than they want the gain. So when it comes to loss aversion, when markets drop, that's why people feel it so much more than when the market goes up 10%. That's kind of interesting. The other one is visceral, and it's a very strong feeling. So one of the things you'll find that it happens from loss aversion is people sell winners way too early, and they tend to hold on to big losers. So for us, we offer perspective on why we wouldn't want to do that, why we own managers instead, so we can minimize the behavior aspect of what it is we do when it comes to loss aversion. So that's number one.
Yeah, number two is overconfidence. We tend to be overconfident in areas that we shouldn't be necessarily confident in. And that's due to our past experience, that's due to who we are as people and what type of personality we have. Sometimes when we are overconfident, we get out of our circle of competence, right? And it's really, really key to stay in that circle of competence and trust others in areas where we may not have that exact knowledge and competence. It reminds me of a Warren Buffett. I'm wearing my Warren Buffett tie today, so I always have to bring up a quote. But he's talking about investors of being able to correctly select investments. And that's what we do for you and with you also as well. But you have to be able to evaluate companies within your circle of competence. The size of that circle is not very important, but knowing the boundaries of that circle are very, very important. So, we have to make sure we're confident. Oftentimes, we trade too often. We tend to play with the money too much. We tend to change the money too much, right? Change the investments. And Warren Buffett says it again. I think Chris mentioned this one last time before, and a lot of you brought it up on the phone calls when I'm with you, so I'm going to say it again, is that money is like a bar of soap. The more you play with it, the less you have. And that's really important when we talk about overconfidence in areas.
Yeah, I think Warren Buffett once said something too in this vein. Let's say you only get 5 stocks to own your whole life. How would you choose those? So it's an interesting point. It's a way to look at discipline for long-term investments. Thanks, Ken. That's a good one as well. The next one is actually called herding. And this is what we just talked about. Herding is people tend to look at humans and each other, and they tend to mimic each other's actions and behavior. So when people panic, that's when people jump at quickly. Oh my gosh, something fearful, and everybody runs some direction. In the markets, it happens. The same thing can happen when, like, there's a baseball card and everybody wants it. Remember, Furbies. I remember when I was growing up, Cabbage Patch dolls. The herding. Oh my gosh, everybody wanted a Cabbage Patch doll. But that's the herding. Let's say everybody goes to Starbucks and there's a line of 50 cars at Starbucks. More people want to go. It's actually proven fact. Well, why is that? Well, because everybody's there. I guess I should be there too, right? And we know we've all felt it. I feel it as well. What's interesting, what does that cause us to do? It causes us to want to buy high and sell low. For instance, let's say just a sample of a stock out there that's just gone from like 200 to 700 in the last 8 weeks. If Ken and I wanted to start talking to people about buying that stock, everybody's on it. Yeah, that's a great idea. Let's buy that. It's really going through the roof. But if we bought one that just had gone from 700 to 200, try using that idea. It just doesn't work well. So when you start looking at it, things that we can do is help focus on the long term. Will there be more people using it, buying their service? Will they be adding more value in the future 5 and 10 years from now? That's more of a Warren Buffett look, if you will, than looking at the herding mentality, which is quick and happens today.
Yeah, when you look at the next one, familiarity. This is a good one. We tend to stay close to what we know, right? Our circle of competence, it kind of comes back to that, So we tend to stay close to what we know. We tend to invest in our things that are in our daily lives that we can understand nicely. But sometimes if we cast that wider net, we tend to do better. And so familiarity is one of those where we need to be aware of opportunities. If you look at, again, we're kind of mentioning Warren Buffett a lot today, but he'll go back and say, we blew it on Google, right? Why? Because not necessarily that familiar with the internet, if you will, right? But there's a lot of opportunities that are out there that we need to be potentially familiar with and kind of get out of our comfort zone when it comes to investing, because when we're out of our comfort zone, that's when we're typically growing. When we are out of our comfort zone when it comes to investing, we're typically growing as well. So there's a nice correlation between that.
Absolutely. So one thing as well, and one of the other biases, bias number 5, is called mental accounting. This is, we tend to attach different values to money based on the source or location. For instance, I had a client once who really wanted this brand new car, incredible brand new car, and they really wanted it, talked about it their whole life, never purchased it, and then their father had passed away, and they inherited a good portion of money. Immediately, within a month, that car was bought. And I asked the client, well, why would you buy that? You've had the money to buy it this whole time. Oh, it wasn't my money. It's essentially what it came down to. So it's interesting to look at how people compartmentalize inherited money versus money they've earned and saved as well. It's a little bit different. So just looking at that, it's called people tend to have naive diversification from this. So they've got we actually had a gentleman back in the 2000s walk in. He had like 64 mutual funds. Like, what are you doing? I said to diversify. Well, they were all large cap growth funds, all with internet stocks in them. You know the story that happened after that in the 2000s. But fortunately, we got to him at a time and he goes, oh, I didn't know that's what they meant by diversification was owning different stuff in between. So one of the things that we do is we look at overlap. Do we have portfolios that have the same names in them? And the answer we find is we try to minimize that, and we don't often have the same funds same stocks in different funds as well. But those five, really, when you look at loss aversion, overconfidence, herding, familiarity bias, and then mental accounting, those are some of the base fundamentals of us as investors and humans we're wired for. These are the things that we look to kind of make sure there's a big difference in value when we're not doing those things as well. Because a lot of it's I'm not market timing, but I just want to get out now. I'm not, there's a lot of those kind of comments you'll get. But so we don't want to also, I think maybe one other one would be self-awareness. Having self-awareness to know these things are there, and we're probably better off not doing these things or being very smart about, that is what I'm doing. I probably should be careful with that as well. So the next portion, and that's in the biases, I think those are things that we really want to take care of. We'll go through more behaviors over time. But I think if you look at this mindsets now, I really want to say something, and this is going to be a perspective of the markets, but if we put it in mindsets, because here's what's going on. The way that we see what's going on right now, you've heard us talk about secular bull and secular bear markets. Secular is just a big word for long-term bear market, long-term bull market. What's happening here is this is a bear market in a secular bull market. Okay, so it went down 20%. In the secular bull market, they don't last as long, they're not as deep, and they recover quicker. So people keep asking this question, well, how can this recover quick? The data is going to be bad. Well, it will be, but in a secular bull market, historically, like we've always taught, they tend to recover quicker. If this was a secular bear market, and I want to make sure that you understand that, in 2000, you had 3 years of pounding, reducing pain of the market going down 10%, and around 20% over those 3 years. And you had two of the biggest buildings in America fall. You had a recession in the end of it as well. So just understanding that a bear market during your retirement period of time is not going to be exemplified by 3-month blips like this and like in October and December of 2018. The perspective we want to add to this during my career is the 2003-year correction that occurred, 2000 to 2003, was long-term brutal, and it made you kind of wonder, are we ever going to get out of this? So that was during a secular bear market. 08 was lasted 6 to 9 months, which was a different time frame as well, kind of shorter. But I just want you to understand that when it comes to a bear market that's 13 to 18 months, the pain is there for a long time. Within 3 months, stocks don't hit some new highs as well. So just taking a look at that, that's some perspective that I wanted to add to this in the bigger picture. How about yourself, Ken?
Yeah, when we kind of dig into the markets here, it's interesting to see what the markets are doing. If you follow this one for 2 or 3 weeks in a row now, I've really talked about value and growth quite a bit. And it's something we're really, really watching right now and monitoring for you because we pair those up in your portfolio. And what's interesting is that value last week, if you take a look at growth and value, the two major cycles in the market, two different types of companies to be investing in your portfolio, value actually led the way last year for the first time in a long time. Usually growth has been dominating through the downturn, through the recovery that we're seeing right now as we speak through this, but value actually led the way. It's very interesting. Now, we're not going to react to that by any means, but we're definitely going to respond to that and factor that in and do the analysis to talk about during our review meetings of rebalancing and things like that, because it does make a big difference for you. Again, year to date, so last week, value was dominant. Year to date, growth is still dominant. Large companies, still dominant. Through all this, small companies have been affected the most, and that's very typical. When we look back, and we look back at the 2008, 2009 that Chris just mentioned, we look back at the 2000s, small companies lead the way down, and they typically lead the way up. It's a very common thing. So it's something that we're watching right now and monitoring just to make sure that we get that right for you. So if the cycle does change from value to growth, we're ready for that for you, and you won't be left behind by any means.
So taking a look as well, one thing I talked about was experts last week. Let me give you a sample. So last month, experts predicted the mortgage market or real estate was going to drop significantly. 22% is what they predicted. You know what happened? We got some data in recently. The market for selling real estate is up 1%. So again, we got to be careful about there's no future facts as exemplified by this. The poor people who predict the weather, the poor people who predict markets, generally long term they're going to go up, we believe. Historically that's been the case, but boy, in the short term it's really hard to tell. So our adaptability and our ability to watch volatility is really the most important piece. So I wanted to go through that piece as well.
Absolutely. We talk about the markets, a couple jokes. Chris threw a couple out there before. We've talked about Amazon, Netflix, Microsoft. Those are some of the companies that are kind of leading the way right now and keeping us all up right now. It reminds me of a couple jokes from Netflix, because we all have binge watched Netflix at one time in our life, maybe still are. But according to a new report, Netflix is losing subscribers and 130,000 people have stopped watching. Why? It all happened after one guy changed his password. The other one is, my wife and I have watched 3 movies back to back on Netflix. Good thing I was the one facing the TV.
Those are good.
So
I like
a couple
it.
little jokes to...
I like it. That's awesome. So one thing we want to do now is talk about the planning process. We only got about 10 minutes left here. So I'm going to have actually Ken go through the planning process. You guys know it, but we'll go through some of the planning process. And then I want to give you something from Russell super quick on there that shows what they believe the value of the process of a planner is with you.
Absolutely. The planning process, we've been through this with you, each and every one of you. It really is something that you're going to see in that best interest regulations that are coming out that I mentioned before. But really, it's really a 6 to 7 step process. And when we look at this, the first one is always discovery, getting to know you, getting to understand you. Factual things are interesting. That's something that we're very good at. We can understand the numbers behind everything. But really understanding what you're looking for, what you're trying to accomplish, is really the first step of that. So fact finding is numerical, but it's also about who you are as a person. How can we help you? How can we we've got a lot of questions and things that you want to hear, like about dietitians. That's why we're bringing it to you as well. That's part of who you are. That's part of the discovery process. But understanding when retirement is for you. What does retirement look like for you? These are all things that we discover. Then we translate those facts into a plan, into a general overall plan, if you will, to kind of fit your needs. What is it? If you want to retire 3 years from now, what does your portfolio look like from a risk standpoint? It looks much different than it probably would 10 years ago. So we're always adjusting. We're always trying to create that plan for you. But a plan is simply a snapshot in time. It's that one day we talk about it. But a financial plan is an ever-breathing thing, if you will. That's why we meet with you and talk with you consistently, because your needs change, your wishes change. We've seen that over the years with you. So someone who is early into retirement has different needs than someone who has been in retirement for 20 years and understands the income part of it all and the comfortability with that income as well. Then we create the plan. We make sure it fits you and make sure it makes your plan unique to you. That's what we're really doing there. Not everyone has the same goals. Not everybody wants to leave money to the children. Not everybody wants to pay off their mortgage. Not everybody wants to do all these things. Not everybody wants to travel the globe. Some people love domestic travel. That's part of the plan, and that really comes from the numerical part of it as well, is what numbers do we need to support your retirement budget? And is it sustainable? That's really what we're looking at there. Map the solution. There's being a fiduciary and being independent, we are able to look for the solutions for you. So what we'll do is we'll throw up kind of 3 or 4 scenarios against the wall and see which one sticks for you. Which one do you like the best? Which one makes sense? We're always going to recommend something that's in your best interest. We've done that natively for a long time, and we'll always continue to do that for you. But that's really mapping the plan and finding solutions that make sense for you. Some of you wanted a little more safety net early in retirement. We understand that. We've built the portfolio that way for you. Now, 10 years into it, again, kind of what I mentioned before, you really understand your income. You really understand what your money is for, and we're able to shift solutions around at that point in time. So that's why we're always talking to you as well. Monitoring the progress, we do reviews with you and rebalances very, very consistently. Where have we been? Are we on track? That's a big one that we always want to answer for you, is are you on track? Is this sustainable? Are we spending the right amount at that point in time? Are we spending a little too much? We have to be careful of that. Or is there a little wiggle room for if you want to take the family on a trip when things open up again? Do you want to go back to Disney World as well? And then we adapt the plan to you and your needs. And so that's really the 6 or 7 step process that we look for you and look out for you on a regular basis.
And the most important part of what Ken just said is one word. It's adaptability. Your adaptability, almost AQ. You've heard of IQ, which is intelligence quotient. Your AQ, which is your adaptability quotient, is going to determine most likely your happiness and success in retirement. Those are awesome, Ken. Thank you. Now, by Russell recently as well, with the study that they had on the value of advisors, they came out with a formula. It's A plus B plus C plus P plus T. What does that equal? I have no idea. But what it is here, the A plus B plus C plus P plus T, A stands for annual balancing, and they think that there's a significant benefit to having annual balancing. B is behavioral mistakes, preventing those, talking about those, something we talk about all the time. C is the cost of basic investment-only management versus managers who actually create alpha and add value. They think there's value to that. Planning and ancillary services, some of the stuff Ken is just talking about, they think that's a big value to the overall picture for a client as well. Tax-smart investing is a really big portion too. So I think the 2 biggest portions they think are behavioral mistakes and then tax-smart investing. And those are 2 things we heavily focus on. It's not something you're going to get. You might get some alsos, but we look at that and look at each scenario really in an individual place. But overall, they think there's over a 4%. This is from Russell Investments, and over a 4% value of having an advisor this year, especially with what's going on. So it's an interesting piece to say, but just giving you some idea what the research out there is saying and doing that we've also seen as well. Now, the last part here, just a miscellaneous piece. Be careful and smart right now about scams. They continue to be present. And for instance, the latest is a text message that you get on your phone, and it says, someone you came in contact with tested positive for COVID-19. And then it recommends that you self-isolate. For more details, go to a certain link. Do not press that link. That's somebody phishing for your information, going in to set a virus in, and that's a virus of a different kind, not the coronavirus. It's a computer virus and a phone virus to steal your information. So again, we just say be extremely careful in that part as well. In the closing, I've got one thing that I'll share, but before I do, Ken, is there anything else in the miscellaneous you'd like to add?
Yeah, there's another text going around too about Amazon, a gift card, $100 gift card. Click here. I think everyone has seen that one.
Yes.
You know, it's very unlikely that someone would want to send you a link to you to click on to get a gift card. It reminds me of like the Publisher Clearinghouse scams that going on for many, many years. A lot of you are familiar with those, but you know, a lot of you have, like, when it looks like your property and casualty, your homeowners, your car insurance. Recently, a lot of you were probably rebated a small portion based on the economic conditions that we've been in. That always gets credited to your account. That's not a link that someone's going to send you and say, hey, by the way, you saved $55 on your car insurance. Check this out. So just be aware of those scams that are out there. They are tempting from time to time because you're like, oh, geez, $100, right? But I think we all know better than that. So just be aware of those pieces.
Absolutely. So the one thing we want to do is keep you safe as well. Not just your money, we want to keep you safe, we want to keep your assets safe. So we're going to bring out some experts eventually too on how to keep safe from some of the internet fraud in the next few months as well. We're searching for the best ones so that you don't waste your time. So interesting, this week I actually had a phone call, and I was on Strategic Coach. I'm coached by Dan Sullivan, one of the most well-known, entrepreneurial coaches in the world. And I was on a call actually with him just recently. We did a breakout sessions, and it was interesting. He came up with this payoffs and penalties. So in this situation we're in right now, what are the payoffs and penalties? One is 3 examples of positive attitudes and behavior that will pay off for people in the new normal. So mine were my clients. This is positive. Adapting to Zoom, adapting to not see us directly, adapting to having some of our team in remote location. And I think the adaptability for clients was something I really credited. Another one is our school and the teachers. They've really adapted to the same, Zoom and working remote. Healthcare, and I guess I'm going to say mothers and fathers who are staying at home with kids to help teach their kids versus letting their kids go off to school. So families have been big. Healthcare workers, obviously. Entertainers giving us free entertainment. My cousin, Ryan Doty, has been putting on shows on Facebook Live, and the team here has seen a few of them, and he's just good, easy listening. So next time he has one, I'll actually send you guys one as well. It's just a nice, easy listening folk-type music. Our team as well has made massive adaptations. So there's some really cool examples of attitudes that I think are going to be super beneficial on a long-term basis that have gone on here. And then he said, what are the negative attitudes? Penalties. What is going to be horrible for people going forward? Well, number one was news and media. I think Fox, which is focusing on extremes, CNN, which is constantly negative news, those two things obviously have been continuing to spew forth some of that because they have to keep people out there. Leaders, they've been finger pointing and they've been blaming. Those are two things that we see. We just want leadership and, hey, help us stay safe, help us do this, but they're spending all their time telling why everybody else is so wrong. So those are a couple of things we've seen. Government in general, inconsistent communication. Different states, different rules, different leaders, different things, striking some things down. So that's been another one. I think that's going to have some negative consequences. And then predictors, financial, economic, medical, and I'm going to add the weather. So those predictors have been off lately. I know this whole last weekend was supposed to rain every day and then it didn't. But again, we give them we understand the weather and everything changes, but trying to make predictions about future facts is very difficult. So it's interesting to think about. What are the things that you will put behind you and things that that will propel you ahead? So what are things you're going to put behind you and not use anymore and things that will propel you ahead? For me, adaptability, slowing down to enjoy, and being present. Those are the three things that I really have gotten out of this time frame that I'm going to use to move forward and to hopefully be better as we go forward. So I got a question for you, though. With all this stuff we've been doing and going to online and adaptability and Zoom, I got to ask you a question. Do you know, and because a lot of you guys are outdoorsmen and you're going outdoors now, do you know the best way to watch a fishing tournament? Live stream it. So again, I heard the laughter through the camera, so I appreciate that one. Despite our joking and our jocularity, that's a big word. I really don't know what it means, but it sounds good. We're serious about our guidance, and we're committed to you. Most importantly, while wealth management is what we do, getting you through tough times and crisis is who we are. Thank you again on behalf of our Gentian team here, and until next week, stay safe, stay positive, and be grateful. Thank you.